Benchmark cools off from the day's high but stays in positive territory just near the 24,300 mark, set for gains of about 1% or so for the week. While broader indices continue to lag, pharma, IT and real estate are the winners today, while PSU banks remain the top drag. Power equipment stocks declined after the government granted a 2-year procurement exemption, allowing 4 Chinese manufacturers with Indian facilities to bid for select transmission projects. The move is expected to intensify competition in extra high voltage transformers and GIS equipment. NBFCs kicked off Q1 with healthy business momentum. Bajaj Finance, Bajaj Housing Finance reported strong AUM growth and robust loan disbursements. M&M Finance delivered healthy lending growth with stable asset quality. Avenue Supermarts reported record Q1 revenue with steady store count expansion but slipped on softer than expected growth, while Marico reiterated confidence in volume-led growth despite near-term input cost pressures. HCL Tech gained after securing a $1 billion AI-led transformation deal from a Fortune 500 client in Europe. The multi-year engagement strengthens its order book, reinforces its AI leadership, and highlights rising enterprise demand. Shares of PB Fintech declined after 1.2 crore shares, or around 2.5% equity, changed hands in 2 block deals. Transaction weighed on investor sentiment despite the absence of any company-specific operational announcement. Adani Enterprises increased its QIP to 15,000 crore following investor bids worth nearly 38,000 crore. The issue attracted strong participation from leading global institutions, domestic mutual funds, reflecting robust institutional confidence. Hello and welcome. You're watching Closing Trades here on ET. Now let's quickly pull up where the Nifty is currently sitting at, and we're looking decent on to close this week out. We're up around 0.5% thereabouts on the Nifty 50 index. 24,300-ish is where we are circling around. The Nifty Bank is under pressure, but the Nifty IT is holding on to its gains. 1.8% high on the Nifty IT index. The Nifty Bank is actually down 0.25%. So essentially the contributors are coming from the IT index, but outside of that, HDFC Bank is standing out. So is an ICICI Bank. Let's pull up both of those stocks. So while the Nifty Bank seems to be in decline, some select private banking counters actually doing okay for themselves. Bajaj Finance is the other one. HCL Tech is the other big contributor on the Nifty, along with the heavyweights. When you're looking at some of the top gainers on the Nifty, HCL Tech tops the charts. 6% higher on HCL Tech. Bajaj Finserv, Max Health, DRL, Sun Pharma. The tilt is pharma, at least on the Nifty in terms of the gainers. That's what we're seeing. In terms of the losers, it's SBI. The top loser, 1.5% lower on SBI. M&M is the other one, 1% or so down. Interglobe, after a few days in the green, has slipped into the red. Kotak Bank, Axis are just some of the other laggards. So it's not just the PSU banks, it's also select private sector banks which are sitting in the red. When you're looking at stocks, and in terms of specific stocks, you'll see PB Fintech down 5%. We spoke about that as part of the headlines. There's a block which has happened there, and a stock obviously was down over 7%, has recovered from the lows of the day. 3% lower on a Sterlite Tech as well is what we're seeing. Adani Enterprises absolutely flat in trade. In terms of some of the updates that we've got, 4.5% higher on M&M Financial, Bajaj Housing doing well for itself, 3% higher. Angel One on the back of the update that's come through. Hindustan Zinc also, Bajaj Finance also showing some good zinc on the back of the update that's come through. Central Bank, I also want to put up Can Bank. That was the other one which came out with numbers. I want to quickly check in on a couple of those and see how the reaction is. Well, flat one on Canara Bank at this point. So broadly, that's the take, but PSU banks are under pressure. So there's some outperformance there. In terms of sectors, now let me pull that up. IT, of course, 1.8% higher, but Realty is leading the pack. 1.9% higher on the Nifty Realty Index. Pharma is doing well for itself, 1.6% higher. Metals is up 1%. PSU Banks is down 2%, Energy is down 1.3%, and the Nifty Bank itself is down around 1/3% thereabouts. The auto index is down around 1/4%. Let me go across to Meryl. She's here with the take on Adani Enterprises because the QIP was launched. 5% discount is what to the floor is what was indicated. 9% lower from yesterday's close, but holding up very well for itself in terms of the stock price. Meryl here with more.
That's right. Adani Enterprises is back in the market to raise fresh capital. The company has launched a QIP with a base issue size of up to 10,000 crore rupees, along with an option to upsize depending on investor demand. Now, the indicative issue price has been set at 2,833 per share. That's a 5% discount to the floor price of this issue, which is at 3,034 rupees, and at a 9.3% discount to Thursday's closing price of 3,177.5. Now, at the base issue price, the company is expected to issue roughly 3.47 crore new equity shares. And as for the utilization of funds, Adani Enterprises says that the proceeds will be used to fund capital expenditure. That's capex for its new incubation business, as well as repay debt and meet general corporate requirements, including potential acquisitions as well as strategic investments. Now, the issue is going to be managed by Jefferies, SBI Capital, ICICI Securities and IIFL Securities, and this marks another flagship major fundraise for the Adani Group. In October 2024, the company raised around 4,200 crores via a QIP as well, followed by 24,930 crores that was raised through a rights issue in late 2025. Now, with this 10,000 crore QIP, Adani Enterprises will be continuing to strengthen its balance sheet while raising capital to fund its next phase of expansion through its incubating business. So these are all the details that we have as of now on the Adani Enterprises QIP. Back to you.
Okay, thank you so much for that, Meryl. Let me bring on board Sudeep Bandyopadhyay, market expert, joining us this afternoon to give us a sense as to how he's seeing this. Sudeep, it's a big development. It's a large fundraise. It's something that Adani Enterprises themselves have done on a recurring basis and very successfully.
Absolutely right, Harsh. I think it is a landmark fundraise, I would say. Raising 10,000 and getting kind of demand for close to 40,000 is in itself remarkable. Also, you have to consider it that this is happening in the backdrop of the DOJ related issues, which kind of sometimes makes us think that probably there will be a little bit of a less response. But I think they have got a thumping response that clearly shows the confidence the investors have in the long-term prospects of the group and Adani Enterprises and their incubation businesses in particular. So I think hats off to this QIP. I think they have got investors like Blackstone, BlackRock, Capital Group. I believe the demand is also from leading Indian institutions, ICICI, HDFC, SBI, Kotak. So I think they have really attracted marquee investors, and that shows the confidence the market has in this company and the group.
What are you most excited about within this entire Adani Enterprises, at least that vertical or that company, which is the flagship company of the Adani Group? Which business do you believe interests you the most, or where a large part of the value unlock may start to happen fairly quickly?
Well, the data center piece is what is the flavor of the season. So the excitement globally is around this AI and related data center and stuff. So that's obviously interesting. But what interests me more is all business. I think that's a fantastic long-term asset which they are creating, and it's really going to at some point of time definitely going to be unlocked, and it's going to be separately listed or some such thing, which will unlock significant value.
Which business was that, Sudeep? Because you broke. I believe there was a network issue.
Sorry, that's the airports business. I'm saying the airports business.
Airports business, correct. Yes, that's scaling up fairly quickly as well. What about defense, Sudeep? Because that's the other one which sits inside Adani Enterprises. It could be a a business which is probably sitting on the back burner but could well ramp up very quickly, right?
Well, absolutely. See, Harsh, I was talking about the businesses which already have ramped up. Let's say, tomorrow morning they choose to take out the entire airports business and do a public listing. I think that will create significant excitement around it. So I was talking about the airports business, which is actually ready for some kind of a corporate action. The sooner or later, one doesn't know. That depends on the corporate strategy, but that is ripe for corporate action. As far as the data center business, because it's the flavor of the season, there's a lot of excitement. And of course, you're right, the defense business in itself can become very, very big. I think it's not that big yet, but it has the potential really to go up significantly.
And what does this do? What does this funding do, basically? It obviously takes out some bit of the debt overhang for Adani Enterprises. Would you therefore be, how would you look at it as an investor? What does it do from a capital structure standpoint, in your opinion?
Well, I think, look at this company, Adani Enterprises. They're investing heavily in multiple businesses, whether it's the airports, data center, defense. So everywhere there in the phase where a lot of investment is required. So repeated fundraising is warranted. And this, 15,000 crore, which they're now garnering along with the green shoe option, I think will be very, very useful for funding the new businesses. Of course, some amount will be used for debt repayment and general corporate purposes, but predominantly, I suspect that it will be used for funding the new businesses.
Okay. How should one look at this particular company itself on a standalone basis? Because there are just so many businesses within it. It kind of gets complicated to analyze Adani Enterprises. It gets difficult. If you can put it more simply as to how should one look at this, should you just look at the big businesses and look at the smaller ones as price to sales? How should one value it? How should one look at it, Sudeep?
Well, I think you have to look at the larger businesses, the established businesses, and try and arrive at some kind of valuation for the company. Yeah, I completely agree with you. It is difficult. And it's like a venture fund, really, if you look at it that way. And it has got multiple legs to grow going forward. And I must say, as far as investors are concerned, it's not for the faint-hearted. There is a lot of volatility, and the counter itself is volatile, a lot of ups and downs. But if you are looking at the long term, if you are looking at the India growth story, I think this company is perfectly aligned with India growth story and is fit for long-term investment.
Dilution, right, Sudeep? Just a 4%. I mean, at 15,000 crore as well, it's just a 4% dilution, and they have diluted, I believe, nearly 40 to 45,000 crore of equity over the last few years through QIPs and the like. The interest has been strong. Do you believe that more such QIPs, more such equity raises could well come in the market going forward as well as they continue to scale up and ramp up this particular company more like an incubator of sorts?
Absolutely. That's exactly what it is, Harsh. It is an incubator of multiple businesses for the group. And once the business matures, I suppose they will start doing value unlocking and listing those separately. This is the right way to go. And obviously, they do need to raise funds periodically in this company to fund these ventures, these businesses. And remember, all these businesses which they are now focused on, whether it's the airports or the data center or defense, they all need lots of capital investment, at least in the initial phases. And that's the reason why they're raising the money.
Right. Okay, Sudeep, great perspective and good having you. It's so tough to kind of break this down, and you've tried to do it as simply as you possibly can. So thanks for that.
Thank you.
All right, viewers, what we'll do is take a very short break, come back, talk more. Mind you, we have a packed show today. We're going to have Alchemy Capital's views on the other side. We'll have Alok come in and give us those views. But outside of that, we'll also have plenty of conversations around power. And thereafter, on the broader market, there are plenty of movers out there, IT being the being the big one. We've Amit Anwani coming in at around 2:30ish to give us a sense of that entire power trend which is playing up. Plenty of action on the other side of this break. You want to stay with us here on ET Now. Welcome back. We're joined by Alok Agarwal, Alchemy Capital Management, joining us this afternoon. It's a very decent afternoon, by the way, viewers. You need to know Nifty is doing fairly well in fine fettle. Alok, really the talk of town right now is IT. How do you position yourself and what's your view there?
Yeah, hi Harsh, good afternoon. Pleasure being here.
Very good afternoon.
The IT stocks we all know has corrected massively, especially this year, and we have seen for the last couple of years itself. And apart from being disrupted or being the fears of being disrupted by the AI side, the fact is the growth numbers being reported and the visibility of the same continues to be lagging. So that's the main reason for IT stocks to remain weak. Until the time we see that growth revival coming back, it will be very difficult for us to position positively on the sector. Just the valuations have corrected from their peak valuations and average valuations. So to that extent, they look cheaper. But when we look at the valuations of some of these companies, the peers which are listed in US, they are still trading at a significant discount to the current valuations of the IT index. So the growth needs to really come back for us to change the stance towards positive side. Till then, we would be on the sidelines.
The impact of AI on IT, Alok. One thing is growth and probably whether that recovers or not. That's one part of the problem. The other part of the problem is revenue, which could degrow. Is that your opinion, or revenue growth will happen despite AI? And how will AI be disruptive to them, according to you?
No, the problems are plenty. There are a lot of coding-related work, etc. Now that can be handled by AI, so that can lead to some of the revenue streams moving out of the current IT services pack in India. At the same time, some of the revenues may be protected, but the margins could come under a challenge. So how our companies adapt? Of course, they are also doing a lot of stuff to ensure that their AI-related orders also keep rising. But how they adapt in a time when things are a little disruptive for them. And mind you, before the AI also, if you look at the last 3, 5, or 10 years, the earnings growth of the sector was barely touching double digits. So without disruption, if something was just about a little under double digits, now with the disruption there, how they hold up, how they guide for it, will be the key thing to watch out for. So how it plays out has to be seen. The impact is likely to be both on revenues and margins.
Alok, do you think that enterprise AI solutions can be delivered to the world without IT services companies? Is that at all something which bothers you in terms of the position that you've taken?
No, frankly, for enterprise IT solutions to be really delivered, you would need those IT services, right? So when one talks about that the growth visibility is missing or the disruption is there, one is not saying that the other side becomes completely irrelevant. That's not the case. The case is the smoother growth rates that were seen earlier, can they be maintained or improved? That is under question. So not the existence or the cash flow generation capabilities. So those remain intact. So their IT services would be required for the implementation of these enterprise solutions. So how the current incumbent IT services companies adapt to it and ensure that they get more and more of those orders, that's the area to be seen. So that's where the commentary of the companies, their guidances, and how they achieve their own guidance, that will be the key monitorables for some of these IT companies in the coming quarters.
Interesting. Other sectors, pockets, how are you looking at the market as a whole? We can go on and on about IT, but talk to us about the market as a whole. How are you seeing the market at this juncture? How is risk reward looking in various parts of the market, large cap, mid, small?
So if you look at the markets in general, last 2 years, Indian markets have significantly underperformed the global markets and the emerging peers. A lot has been said about it, but the fact remains that a close to 60 to 70 percentage points underperformance on an absolute basis in last 2 years that itself makes the risk reward quite attractive for the Indian markets. Absolute basis, we have barely increased anything in the last 2 years. Yes, there have been a lot of proactive steps being taken by both the government and the RBI to ensure that the growth numbers come back much faster than expected. There had been challenges, be it on the trade war front or on the rising crude oil prices, but all have been navigated pretty well. And we can see some of the green shoots in terms of corporate earnings numbers as well. Even the last quarter, the Nifty 500 delivered a close to 15% earnings growth. So the numbers seem to be coming back. While GST collection numbers, which we follow as a proxy for how the economy is doing, well, those numbers still continue to be in a single-digit growth numbers. But if you look at the sequence in the last few months, month on month, they have been improving. Another factor that is showing some green shoots of growth is the fact that the credit growth numbers have started inching towards 15-16% mark on a sustainable basis. So the growth marks are coming back. The higher valuations in Indian markets have got corrected themselves through a time correction of close to 2 years. So due to which the risk reward continues to be attractive. Some of the leaders in terms of index heavyweights, in terms of those sectors, they are the ones which are not being able to grow at a faster pace. But deeper down the broader markets, some of the sectors are doing pretty well and growing at a good pace. So that's where we see that the risk reward is attractive, but the action is more in the non-index names.
Okay. And Alok, in terms of sectors, themes, what are you liking at this point? Is it something, now that we've got a large part of the war overhang going behind us, crude also cooling off substantially, are you more constructive overall as well versus what you were maybe a month ago?
Yeah, the uncertainty that was attached to the war and the fact that the crude oil prices went up, which actually impacted India disproportionately, at least that part going behind is a welcome positive for the Indian markets. Apart from that, the sectors and the areas that are showing the kind of growth, we all know, if I look at them one by one, globally, the growth engine has been the AI engine, and India fits well in that AI engine through its power segment as well as the metal segment. The second major theme globally that's going on has been the fact that there has been a rising geopolitical tension. And we know that the defense theme is the one that has a much, much longer legs, or maybe a 10-year plus growth story ahead of us in India. Globally, 2.5% of GDP is spent on defense currently. During Cold War times, it used to be close to 6%. With the fact that US being withdrawing their protection cover, security cover from the NATO countries, it wouldn't be surprising to see defense expenditure to GDP rising closer to 6% in coming years. And it's all coming at a time when India has been investing a lot in improving its own production capabilities and exporting capabilities. So that's where the longer term growth opportunity is there in that sector. Domestically, a couple of other themes that's doing pretty well has been the financialization of savings. Indians have been savers predominantly always. Earlier, the savings used to get channelized primarily towards the savings accounts and fixed deposit accounts. And they are now increasingly more and more getting channeled towards the capital markets. Earlier phase, when the deposits were being accreted at the banks did so well. In 2004, their weightage was close to 4% in the index, which rose to close to 20% by COVID. And now that same amount of savings is moving more and more towards the capital markets. That's where the capital markets whole value chain is actually benefiting a lot, and there could be a longer runway of growth for them. And lastly, I do see a lot of opportunities in the pharmaceutical space, especially on the CDMO side, as well as on the API and the CRAMS side, and as well as domestic hospitals. So some of these names that I just mentioned, a lot of them are not really there in the main index heavyweights, but a lot of action, a lot of tailwinds, a lot of structural growth ahead of them.
Viewers must know Alok is extremely stock specific. He's a bottom-up investor. So while we're talking themes, you may have to do a little bit of your own filtering before you take his advice. But Alok, a little bit more on healthcare, because that's an interesting pocket. It's already done very well. How do you differentiate the wheat from the chaff? How do you probably now start to look at opportunities once the run-up is done? how do you differentiate between what's going to work from here and what's not?
No, in fact, let me divide pharma into two parts. As I said, one is the makers of those medicines and the CDMOs and the API companies, and the other side is the hospital side. So in terms of the medicine manufacturing, we do see India has actually developed a lot of its niche and a lot of its capabilities and demonstrated that's an area that we can produce some good quality stuff at a very, very competitive price. And a China plus one strategy there comes in handy for a lot of these companies. And the rupee depreciation is also benefiting them. But the growth visibility is the one that we look for, the ones that are delivering well on their earnings growth and where the customers are giving them more and more repeat orders, wherein the growth numbers are far, far better. On the other side, the domestic hospitals, while they get classified under the healthcare and the pharma space, a closer look shows that actually they are more of the private hospitals catering to basically the top part of the population. To that extent, it has all the makings of a consumer discretionary, and that sector has been doing pretty well. Several years ago, it was difficult to spot very scalable kind of names, which would have kind of a pan-India presence. They were very, very localized, but now there are a number of companies which are gaining prominence and spreading their wings across multiple cities, states, and some of them almost moving to the pan-India level. So a long runway of growth on both these segments, very different.
Determine which could be good and interesting investments. Thank you so much, Alok, though, for coming in and speaking to us.
Right, let's take a look at the stocks buzzing in trade this afternoon. And starting off first with Shivalik Bimetal Controls, where the company is in focus after its arm received the consent to operate for its new manufacturing facility in Solan, Himachal Pradesh. Now, this approval clears the way for commercial operations at the new plant. Next is Blue Spring, which is buzzing after its arm secured a 1,437 crore rupee order from Vedanta Aluminium. Now, the contract is for operations and maintenance of a 1,215 megawatt captive power plant, adding meaningful order book visibility. AWL Agribusiness is also seeing action following a bulk deal where Australian Super offloaded around 1.65 crore shares, while ICICI Prudential Mutual Fund picked up nearly 1.3 crore shares at a similar price. Meanwhile, Mahindra & Mahindra Financial Services is in focus after reporting a healthy Q1 business update, where disbursements grew 21% YOY, business assets expanded 12%, and collection efficiency remains strong at 95%, and the asset quality continued to stay stable. Lastly, Union Bank of India is under the spotlight after its quarterly business update, where while the loan growth remained healthy, deposit growth was relatively weak, with deposits and CASA balances declining sequentially, making the update softer as per the market expectations.
Well, thank you so much for that, Darshita. In fact, Union Bank, the QOQ numbers looked extremely soft, and therefore you're seeing the kind of knock on the stock. Let me also, in fact, slip into a very short break, come back, speak to Amit Anwani, because what else is looking soft? It's the power ecosystem, which is taking a bit of it on the chin because of the approval which Chinese manufacturers have got for the next 2 years. We'll speak to Amit about that trend and what could likely translate in terms of the impact of that. Stay with us. On the other side, we'll have Amit. Welcome back. And the transmission equipment space has come into focus. In fact, stocks are under pressure after the government granted a 2-year exemption under the public procurement order, allowing 4 Chinese companies with manufacturing facilities in India to bid for select PSU transmission projects. Sneh here with more details.
Well, yes, so the entire power transmission pack is under massive pressure today. We're seeing cuts of around 8% for most of the names belonging to that pack. Take a look at names like Hitachi Energy, Siemens, Tyrrell. You got TND that's under pressure as well. And the reason behind all of this is on the back of a government decision wherein Chinese competition is now going to be allowed to bid on certain PSU projects. The government has granted a 2-year exemption to 4 Chinese-linked electric electrical equipment manufacturers, allowing them to participate in select PSU transmission equipment tenders despite existing procurement restrictions. So this matters for all of these companies because these Chinese companies can now bid for high-value transmission projects, increasing competition for Indian manufacturers. More bidders typically mean more aggressive pricing, which could put pressure on margins and reduce the pricing power of the incumbent Indian players in this category. And the biggest impact is expected in the 765 kV and 400 kV transformers, GIS equipment, HVDC systems, and ultra-high voltage transmission projects. Some segments where Chinese players already have very strong capabilities, and companies that are currently under pressure and exposed to a lot of these segments are Hitachi Energy, GE Vernova, Siemens, CG Power, transformers and rectifiers, Quality Power, Indotech transformers, and you've also got Atlanta Electrical. So yes, these potential manufacturing bids from Chinese players may put Indian companies under pressure. They may have to lower prices to win orders, and this could weigh on margins and profitability. While all of this is a potential of the outcome that we've seen on the government's front, this is the sentiment that is building up on the street when it comes to power transformers, and which is why the entire basket of those stocks is under pressure.
Yeah, it is. And this is just the first wave of selling, which is coming by for a very, very concentrated sector with extremely, large positions in most of these names. And thereby, you're seeing such a sharp correction as well play out in this entire pack. But we've got Amit Anwani as well joining in on the show to help us analyze the impact on these stocks. Amit, hi, afternoon. Good to have you on the show. Amit, how are you analyzing the impact on some of these transmission equipment companies after this government grant of 2-year exemption under the public procurement order, and which will now allow for Chinese companies as well with manufacturing facilities in India? And how can they actually come out of this hurdle?
Right. Thank you so much for having me. So I think first thing, as explained, all these 4 companies, when we see their product basket, TBA is very well known. They're present across 765, 400, HVDC, plus few other products like reactor, and they're already there in the market. They have roughly about 20,000 MVA capacity, as we understand, and have been servicing the private sector already in India. The other 3 companies, I think broadly also present across insulation, bushings, reactors, and few of the companies, as I checked, were also already supplying to the private sector. So I think the key takeaway here is this is a deliberate notification to support or fast track the projects. Second, to also kind of address the lead time and supply chain issue, which might also be impacting the sector. And probably more clarity, probably the PSUs or the other projects related to government might be not taking from the Chinese companies, that now with this regulation is something which is allowed. So now, as we gather from the previous discussion with all of the HVDC companies in January, when the similar kind of notification came, I think most of the companies were of the view that there's a supply chain issue which is impacting the sector, including bushings, insulations, and few other products that definitely might get eased with a perspective of HVDC execution, and they were not sensing any threats. And if I put this in broader context, the government is trying to localize a lot. So there is a regulation in place for HVDC players to go have a minimum localization content of 60% by F35. So all these allowing of Chinese would derail all of that. So I think this is a deliberate move to address the near-term challenges till the time the domestic capacities are really ramped up to meet the very strong demand, which has created a multi-structural pipeline for many T&D product company, I would say. And we have seen collectively all the MNC companies have a very large-scale capex already announced, including Siemens, Hitachi. If I add, probably it is more than 10 to 12,000 crore capex they have envisaged. And definitely all of these companies are talking very big.
Okay. We'll go back to Amit in just a minute. I believe we've lost him, lost his line. Do we have Amit? Basically, I think what Amit was saying, Aisha, was that this is, of course, to ensure that the kind of demand that we're seeing is being met and being met at a fair price as well. And of course, there is thereafter a concerted attempt to doing this within the four walls of India. Okay, we have Amit back. Amit, yeah, I mean, we hear you. I'm trying to understand, therefore, over the next 2 years, what this does to pricing. Is it disruptive to pricing, and therefore will it impact the top lines of these companies? Is it relatively okay because the demand is just extremely strong? How should one think of it?
Right. So definitely pricing there is something which can normalize in pockets. And we have seen and we have been hearing all of the MNC companies and even from the government side, there is enough data to support that this is a structural story because of the renewable integration, T&D capex, and many companies are really expanding capacities. So definitely, but this incremental kind of competition from Chinese, especially probably in the government-related projects, is something where the pricing can normalize for few players. And I sense probably this could be the case for small mid transformers, switch gears, and insulators, bushings, all this vendor base, or probably the more price-sensitive sectors would definitely see some price intensity because of this allowance. But having said that, if we read the notification, it also speaks about these Chinese companies, if they really want to kind of supply to the Indian sector, they have to have a local factory. So all these 4 factories, we have to also see that whether these companies, Chinese companies, will invest more in India to supply to government. That could be a long-term challenge. But I think initially, as we understand from whatever names we are hearing, the Chinese names, they already are present in the market. They have been supplying to private sector, and this could be incremental to public sector, where probably there might be few bottlenecks with the projects, and prices definitely should normalize and impacting smaller vendors. I would say there could be some impact there for sure.
What does this do to your estimates, Amit, in terms of top line estimates as well as margin estimates? What does it do?
Right. So see, for the larger players under my coverage, including GE, Hitachi, Siemens Energy, GE and Hitachi, because the multiples for all these companies have seen a tremendous rally, and they were trading between 70 to 80x. So in 4Q, we anyways downgraded this company, citing the very high valuations. And I think my estimates may not get impacted because we checked with these companies in the past when this notification came first in January, and they cited probably this may not directly impact them. Their products and technologies are very well versed, and there's already a very strong demand basis the technical requirements of the HVDC projects, including LCC and VSC. So I don't see any direct impact there. As I said, probably the impact I'm sensing in Yash High Voltage or Voltamp or Taril, there could be some impact if their categories of transformers are supplied by these Chinese companies to the government. So broadly, we anyways, because of the steep valuation, downgraded a lot of stocks. For G, we have gone from accumulate to hold, and for Hitachi from accumulate to reduce. Anyways, because of the very high valuations they had before this notification also.
Okay, that's quite a legit call there. But Amit, great to have you on the show today. Thank you so much for your analysis. Okay, let's take a very quick break. Lots is buzzing in the market as well. A little bit of volatility has crept in, definitely. Let's see how the last lap pans out. We'll track it on the other side.
Some of the stocks which are buzzing in trade at this hour.
Yes, here's a few stocks that we've seen buzzing in trade today. Starting first with Raymond Realty, in focus and strongly in the spotlight after a very good first quarter update that they've just put out. Collections have jumped 47% year on year for the company to 550 crores, while pre-sales have more than doubled, reaching 700 crores, reflecting healthy demand, momentum and strong execution across its residential projects. Zydus Life Sciences is another name in focus. The company has partnered with Apollo Hospitals to expand access to its multi-cancer detection, that's their MCD test. This collaboration is strengthening Zydus's presence in the advanced diagnostic space and also supporting the overall growing focus that we're seeing in the industry on early cancer screening. Schneider Electric Infrastructure is another name in focus. They have revised their capex for expanding the Kolkata medium voltage components facility, with the planned investments now being increased from earlier 138 crores to 184 crores, signaling higher capacity addition and continued demand for power infrastructure equipment for the company. And finally, Inventures Knowledge Solution is in focus again. They have provided an update on its TrueBridge acquisition, where the company has reduced the acquisition loan size from 670 million to now 635 million. Now, they've also confirmed that once the deal is going to go through, HRG Inc. will become a material subsidiary. This is already a subsidiary of TrueBridge acquisition, and it will continue to be a very material step-down subsidiary for Inventures Knowledge Solutions as well. And now the lower borrowing over here, the 35 million that has been reduced on the borrowing front, is providing a strong positive momentum to the stock in today's trade. So yes, these were a few stocks that we've seen firmly in the spotlight.
Okay, those are some of the buzzing stocks. Cane's holding out very well, 6.5% higher right now. There's HCL Technologies up 6%. Nalco, of course, has been a very strong show from the word go today. Nuvama is perked up very nicely too, a good 4.5% up in the green, and 361, which is holding up over 4% as well. So all of these stocks are actually making up for the broader market strength today, though it's come off a little bit from the top of the day, but still in favor of the advances, at least within the F&O pool. And within the benchmarks, of course, HCL Technologies, Max, Sun Pharma, Apollo Hospitals, Bajaj Finserv, Bharti up 1.5%, DRL. These are all the names which are also looking good, along with some of the metal names. But Kunal is here in the studios. Kunal, what are you making of the market texture and, more importantly, the composition of sectors now?
So again, IT stocks today are the ones which are performing very well. You've seen some reprieve which came back, I think, the first half for the FMCG names. But then I think it's more towards the short covering spree which you're seeing for the select sectors. Pharma, for example, has been doing pretty well for itself. Today also, I think we've seen a few large cap names on the pharma side looking a little bit more attractive. They've carried forward the momentum from the last couple of days of the price up move. So I think it's more selective, more broad-based. The concern for the markets, of course, and the reasons why you're seeing slight bit of an underperformance is because of the sell-off or the mild selling picture which has come back into a few of the large cap private sector banking names like Axis Bank, the PSU banking major, SBI. So, but I think it could be just about one-off because you're seeing the index now charting a new, I would say, a breakout about 24,250 mark, and hopefully, if you just close about this 24,250 levels, this could probably be a multi-week breakout signal for the index. And looking at the market composition over the last 3-4 days and over the last few weeks, it just looks like that maybe with the next leg of price uptrend, you might have a completely different sector composition and a new rotation in terms of the sectors.
Okay, let's get in some more analysis on what's really happening within the F&O universe, and Sajid is here with that update.
Thanks, Aisha. Nifty 50 is seeing some shorts getting covered there in today's trade, and we've given up some of the morning gains, so it's hovering about 24,261. So at one point in time, it was about the 24,300 level. So there is an aggressive call writing which we have seen in the last 2 hours, and that's also putting some pressure on Nifty. The open interest down nearly 0.6%, and that gives you an indication of the shorts which is getting covered there. Nifty Bank is lower in today's trade there, where we're seeing nearly 3% jump in open interest, and that's primarily the shorts getting built in the bank index. And if you look at the constituents, many of them, especially the POC bank side, is adding short positions at this point in time, except for HDFC Bank, which is seeing a short covering, and ICICI Bank with a long build-up, and Indus with a long build-up. Pretty much across the board, you are seeing short build-up for banking stocks in today's trade there. But look at what's happening in call and put writing. We saw aggressive put writing in the morning at 22 24,200, 300 and 400 levels. But in the last half an hour, 1 hour, we have seen call writing happening in 24,300 and 24,400. As a result of which, you are seeing a distribution where 24,300 has a higher call writing at this point in time, and that's keeping the market in check. Nifty just above the 24,200 level for that. In futures gainers, you have a couple of stocks which are interesting. Keynes Tech up 6.4%, long build-up. HCL Tech seeing a short covering which is coming in. Lodha is seeing a long build-up there. In the losers pack, you have stocks like GVT&D, Hitachi, CG Power, all of them from the capital market electrical space after the government notification for extension of eligibility for some of the Chinese companies which is coming. So all of them down in nearly 7 to 9% in today's trade there. In open interest gainers, you have PB Fintech, which is seeing a short build-up. Avenue is seeing a short build-up, and CG Power is seeing a nearly 20% jump in open interest in today's trade. In losers pack, HCL Tech is one of them where we are seeing some shorts covering happening, open interest losers basically. And then you have stocks like Oracle Finance and NHPC where we are seeing some shorts getting covered there. Most interesting stock options today is Sun Pharma 1900 July call, 47,000 contracts getting added in open interest. The premium up nearly 15 to 34, so roughly around doubling of the premium happening in today's trade, and stock hovering around the 1900 mark at this point in time. The other one is HCL Tech 1100 July put, which is very active, where the premium has fallen by 30 to 26.35. There's an unwind of position which is happening. Nearly 22,000 contracts have fallen, and the stock hovering around 1133 at this point in time. So market holding on to the gains. For the last 2 days, we've seen shorts getting covered, and as a result of which the market has edged up to about 24,250 levels.
Okay, thank you so much for that, Sajid. What we'll do is to bring a very short break, come back with more. Stay with us, plenty to talk about.
Back with closing trades right here in 80 now. We're holding out quite okay. That little bit of choppiness, of course, played out largely to do with the way the Nifty Bank was panning out. We're definitely off from the top of the day, but we're still holding on to the 24,300 plus mark on the Nifty futures. Axis, SBI, L&T have got to be your key pressure points today. Other than that, M&M, Unilever, but again, these are stocks which have had a phenomenal run all through this week. They're also pausing a bit. Reliance as well has flattened out. Interglobe Aviation has flattened out. And Maruti, the top performer perhaps this week from the Nifty 50 names, that's also looking pretty quiet in trade as we speak right now. Sunny Agarwal also joins in on the show to talk about what he's making of the market right now. Sunny, hi, afternoon. Good to have you on the show. Let's try and dissect what you're reading for the large cap banking names, Axis, SBI, Kotak, HDFC Bank.
Good afternoon, everyone. Coming to banking name, the kind of provisional update which we are seeing for 1Q seems that the credit growth at least will be in a kind of mid-teen numbers for most of our banking measures. And as we have seen that because of a lot of liquidity measures taken by an RBI, even mobilization of deposits should not be a challenge, especially on FCNR side, which will be one of wherein the key beneficiary will be predominantly a private sector players like HDFC, Axis, and to some extent on PSU side, Bank of India, which has got or Bank of Baroda, which has got a significant exposure as far as international markets are concerned. So overall, banking as a sector looks very well placed to deliver a healthy double-digit kind of earning growth for FY27, predominantly led by stability in the NIM. Maybe 1Q we may see to some extent minor pressure on NIM, but overall on a full year basis, the NIM should stabilize, and that should aid a decent earning growth going forward. Even in terms of asset quality, we have seen no deterioration as per the various banks which have reported a provisional update. Even on valuation side, valuation continue to remain comfortable. Most of the private banks are trading closer to 1.8 times to 1.9 times price to book multiple, whereas PSUs are trading in the band of 1.2 to 1.5 with a kind of mid-teen ROE number that is expected going forward. So I think well-placed banking as a sector is well-placed. Obviously, within that, what we feel is that HDFC Bank in FY27 may report a kind of industry growth at par with an industry. And then in FY28, we may see a growth exceeding the industry. So a top pick among the private sector remains among the large cap private sector pack is ICICI Bank, where we feel it will continue to outpace the industry growth. Among the mid-sized bank, what we feel is that few players like Federal Bank, Karur, CSB should do well.
Sunny, what's your sense of earnings growth for FY27 within the banking pack? Will it be mid-teens? Will it be just about double-digit? What are you penciling in?
Again, coming to banking pack, what I feel is that few players which are outpacing an industry credit growth, they may report 17 to 18% kind of earning growth. So few players which comes to my mind is Axis Bank, where we have seen a kind of muted performance during the FY26. So on a low base, FY27 should turn out to be a better year for Axis Bank. ICICI Bank continue to deliver an outstanding performance going forward. For a likes of HDFC Bank, again, the growth should be in the range of 13 to 15% for FY27.
Okay, let me go across, just take a bit of a pause on the conversation, go across to Snehi. A broad-based moderation in key raw material prices could provide relief to several FMCG companies. Cocoa, copra, crude oil have all corrected sharply in recent months, potentially supporting margins for companies across food, personal care, paints, home care. Snehi here with the trends.
Well, absolutely. If you take a look at the raw material momentum that we've seen coming in across the board for a lot of FMCG staple companies, a lot of their key raw materials have seen a deflationary move in the month gone by. We've got the war pressure also that is now receding, and on the back of that, you've got Brent crude. Let's start by talking about the sectors, the companies that fall under paints, packaging and personal care. The biggest downfall coming in on Brent crude, 16% lower, and the likely beneficiaries are companies that use palm derivatives as a raw material. So you've got Asian Paints, Berger, Pidilite in the chemicals front, Dabur, Marico, HUL. All of them stand to be the biggest beneficiaries of the 16% softness that we've seen on a month-on-month basis in Brent. For copra then, Marico has been in focus on the back of its Q1 update, and the biggest reason why it's done so well is that there has been a sharp slowdown coming in, about 10.5% on copra prices. So oil makers like Marico and Dabur stand to gain from this. Next, let's talk about PFAD, which is palm fatty acid distillate, which is used as a raw material for soaps. A 1.5% cool off in terms of a month-on-month pricing. So soap makers like HUL, you've got Godrej Consumer and Jyoti Labs. All of them stand to gain on the back of this softness. And you've also got alkyl benzene that is used as a raw material in detergents. That has also seen about a 1.5% cool off month-on-month. Once again, it's these soap players who also make detergents, HUL, GCPL, Jyoti Labs, that stand to gain from this. Shifting focus then, let's talk about food input cost ease, and FMCG margins may improve on account of this. On the back of that, some food-related commodities, wheat is lower by about 2.5%. So biscuit makers and companies that use wheat flour as a raw material, Britannia, Nestle, ITC, Mrs. Bector's Foods, all stand to benefit from this. Cocoa prices are lower by 2.5% month-on-month, and the biggest chocolate maker in the country, Nestle, also stands to gain from this. Refined soybean oil has seen a cut of 1.5%, about that much on a month-on-month basis. So edible oil makers, Marico, who makes Saffola, Adani Wilmar, Patanjali, all of these edible oil makers also stand to benefit from this. Next up, let's shift the focus to beverages and oral care. In the beverage segment, coffee has seen very flattish moves, but that is positive for coffee makers like Tata Consumer, HUL as well as CCL products. Let's talk about maize. The extract from maize sorbitol is used in toothpaste, and toothpaste makers like Colgate, HUL and Dabur will benefit from this 2% softness seen on a month-on-month basis. Let's also talk about mentha oil, which is a cooling substance and a flavoring substance used in hair oils and cooling products. 1.5% softness there. So you've got Dabur, Marico, GCPL and Emami who stand to benefit from this. While this is a list of all the raw materials that have seen some softness and the beneficiaries, remember that on a year-on-year basis, some of these commodities are still quite elevated. On the back of all the geopolitical pressures that we've seen in the previous few months, albeit they're now easing, Brent crude still continues to be higher by 58% on a year-on-year basis. You've still got palm fatty acid distillate that is used in soaps that's seeing an inflationary trend, as has been the case with soybean oil, with LAB as well as mentha oil. So while we're still waiting for further moderation on this, even the month-on-month move seen in the latter half of Q1 could be very beneficial for staples earnings in Q1.
Right, okay, that's the impact of raw material prices easing and the kind of follow-through it's having for, or rather the impact it's having for most of the staple companies. And you saw that play out with Marico's quarterly performance as well, given the 45% cool-off in copra prices. That said, let's try and analyze where these stocks are. And Kunal, you were talking about a bullish call on a Nestle, for instance, day before. We've had Dabur, Marico, Unilever, all these stocks perform very well through this week. You think this strength is here to stay come next week too?
It looks like, Aisha, because it's now trickling into those large cap names which are seeing a sustainable move for themselves. More importantly, I think what we are seeing for those larger cap names are breakouts. And FMCG stocks, historically, that whenever these stocks have confirmed short-term breakouts, they've actually moved up into multi-day, multi-week time frame in a very slow, gradual manner. So when we look at the price trends and the structure of these price charts, the fact that these stocks have stopped falling and then participating on the days when the markets are showing signs of strength and then moving in a synchronized manner. When we look at all of these patterns coming together for the FMCG pack, this looks very attractive and this looks more sustainable for these stocks. I would still believe that Marico, I think, is one of the stronger ones in the pack. Nestle is, ranked number 2 in the sense of relative strength, looking at the price performance of late, as well as HUL, Britannia, Dabur. I think they are the ones which are showing signs of high potential breakout. So it depends on how one is looking at it. If you're looking at trying to catch up in terms of more of alpha, in terms of returns, then I would believe that the likes of HUL, etc., they could be the ones which could outperform. But if you're looking for consistency and leadership, then I believe Marico and Nestle are the best bets.
And any other stocks that you would recommend to trade right now?
So yeah, there are a couple of them. In fact, out of the pack so far, from the IT pack, I think HCL after this gap up move is something which starts to look attractive. So that's a stock which I would recommend at the current juncture. Trading at 1130 approximately, would look out for now the next target on higher side of almost 1165. Stop loss could be kept at 1125. And the second would be a buy on HUL. That's a stock which I was discussing earlier. Trading at 2210 approximately, would look at a target of 2280. Stop loss at 2180.
Okay. In fact, let me take it across to Darshita. She's here with that big win that HCL Tech announced this morning. $1.14 billion strategic AI-led transformation deal from Europe-headquartered Fortune Global 50 company. The contract, which runs through to December of 2031, is entirely new business and will help build an AI-driven digital workplace and enterprise network. Darshita here with the highlights.
Right. HCL Tech has announced one of its biggest AI deal wins in the recent years. And the company has signed a $1.14 billion strategic partnership with a Europe-based Fortune Global 50 company. Now, the contract will run from July 2026 till December 2031 with an option to extend it for another 5 years. Now, the biggest highlight is that this is entirely the net new business. In the simple words, this is not a contract renewed or an expansion. It's a completely new client for HCL Tech, making the win even more significant. So what will HCL Tech do? Basically, the company will build an AI-driven operating model for the client's global digital workplace and enterprise networks. Essentially, HCL Tech will use AI to modernize workplace operations, automate the processes, and improve the client's IT infrastructure. So from an investor's perspective, this is an important deal because it adds a large multi-year engagement to HCL Tech's order book, improving the long-term revenue visibility. Now, the fact that the client is Fortune Global 50 company also reinforces HCL Tech's ability to win large global transformation deals. And yes, one more thing to remember is that the entire $1.14 billion won't be booked immediately. The revenue will be recognized gradually over the contract period, creating a steady revenue stream over the coming years. And if the extension is exercised, the relationship could continue well beyond 2031.
Okay, thank you so much for that, Darshita. Sunny, if I were to ask you for your top picks within the IT basket, what would those be?
Again, coming to IT pack, would like to split it into two parts. On tier 2 or mid cap side, we believe that Coforge is likely to deliver a healthy earning growth, followed by First Source Limited. So kind of mid-10, 12% to 15% kind of growth is expected. But again, upcoming commentary during the Q1 numbers will be a key important metric to track for remaining period of FY27. Coming to tier 1 companies, all the companies are trading at a very reasonable valuation, closer to 12 to 14 times FY28 price to earning multiple. So what we feel is that right time to accumulate HCL Tech. Again, there we have seen promoter buying that has also emerged at a lower level. And at the same time, with an investment in Sarvam AI, we believe that even that opportunity can unlock from a medium to long-term perspective. So HCL Tech followed by Infosys, where we feel that again valuations are very comfortable. But one has to keep in mind that if somebody is investing in IT pack, it need to be a kind of very patient capital, because FY27 is likely to be a muted year in terms of earning growth, and all the eyes will be on FY28 in terms of revival to a kind double-digit kind of earning growth. So patient capital, or otherwise someone can deploy capital gradually over the period of next 6 to 9 months.
Okay, that's the take coming in on what the IT stocks are up to. But banks, they've also, of course, been in focus the past fortnight, but now they've started coming up with their quarterly numbers. In fact, just last evening, you had some of the NBFCs, reason why Bajaj Finance and Finserv are holding out today, also come out with their quarterly updates. Mithali is here with a wrap.
Rightly said, so the banks, they continue to give standout metrics for the business update for Q1 FY27. On a healthy note, the kickoff has started with credit growth continuing to outpace the deposit growth. Equitas SFB, it led the pack with 70% growth seen in the microfinance portfolio, while CSB Bank also posted strong term deposit growth. Punjab National Bank's global business, it neared 30 lakh odd crore rupees of milestone, while Central Bank of India, UCO Bank and Union Bank, they continue to deliver robust credit growth, outspacing the deposits. While talking about Ujjivan Small Finance Bank, it maintained strong loan book expansion backed by healthy deposit growth. Starting off with CSB Bank, it stood out with its term deposits, which surged nearly 33% on a yearly basis, highlighting a strong liability franchise. Gross advances, they also grew nearly 24%, while the CASA deposits, they remained quite stable. Punjab National Bank, it inched closer to that milestone of 30 lakh odd crore rupees. The deposit growth, it remained healthy at over 8.5% on a yearly basis, while both domestic as well as the global business posted consistent sequential growth. Talking about Union Bank of India, it reported another strong quarter of solid credit growth, with gross advances rising 12.5% on a yearly basis, comfortably ahead of the deposit growth. Moving now to the small finance banks, so Equitas Small Finance Bank, it stole the spotlight. The microfinance portfolio has surged nearly 70% on a yearly basis, the fastest growth across the pack. Gross advances, they remain strong, while deposit growth stayed healthy, although the CASA ratio has quite moderated for this quarter. Ujjivan Small Finance Bank also reported a robust quarter for this one, with the gross loan book expanding 29% yearly. Deposits grew 25%, while the credit to deposit ratio, it remained broadly stable. Central Bank of India, it impressed with nearly 29% of growth in gross advances, significantly outspacing the deposit growth. And finally, talking about UCO Bank, also reported a strong lending momentum for Q1 FY27, with total advances up over 21% yearly, and domestic advances growing even faster at 22.5%. So overall, across the pack, the credit growth, it remains quite resilient, and the deposit mobilization and the CASA trends, they continue to be the key monitorables going forward.
Oh, yeah, absolutely. And Bajaj Finance has been the strong one. Kunal, haven't taken stock of Bajaj Finance on the charts. How's it looking?
Yeah, it's looking a little better than what it was maybe 3-4 months back, because, a couple of months back, the stock was just about going through a major grind, started to correct from 1100 levels to as low, I think, as 800 mark, till March 2026. And from those 800 levels is where the stock is now coming back into some sort of recovery. It's come back about the 200 moving average. That's a very strong positive for Bajaj Finance. Still 10% down from its previous highs or the major highs, lifetime highs for Bajaj Finance in that sense. But I would still believe that with this comeback about the 200 DMA and this in correlation with the other stocks which have moved in the pack, you look at the likes of L&T Finance, AB Capital, etc. These stocks are also back again on the verge of their fresh 52-week high. So I think in that sense, this momentum for Bajaj Finance should continue.
Okay. Sunny, if I were to try and get your sense with regard to metals, we've seen a decent correction on spot prices. impact on the metal index in your view, and is a lot of that done and behind us?
Yeah, I think you rightly pointed out that definitely there has been a sharp correction with an ease in concern as far as Middle East war is there. So, and at the same time, there was a narrative that even in US we may see an interest rate hike, which was giving a strong upside momentum to an dollar index. So that has led to a very sharp correction in the spot prices of underlying commodities. But having said that, what we believe is that a case in point like aluminium, which has hit the highs of $3,700, $3,800, that is now trading closer to 3,000, 3,100 on a per ton basis. But if you look at analyst estimate, I think most of the analysts have built in for non-ferrous aluminium side in their model number of $3,000 to $3,100 per ton. So in terms of earning surprise, there won't be any negative surprise even if the prices continue to hover in the current range for remaining FY27. So we continue to remain bullish on non-ferrous pack, especially aluminium. And if somebody want to deploy money, I think Nalco is the best stock. And at the same time, the recently listed entity, which is Vedanta Aluminium, can also be considered. Another pack which we like among the metal is stainless steel, and the proxy play to that is chromium, for which the Indian Metal and Ferroalloys is an listed entity that we feel because of the recent capacity addition, both organically and inorganically, can deliver a fantastic growth in FY27 and FY28. So Indian Metal and Ferroalloys is another pick from a metal pack.
Okay, Realty, that's the other one which is in focus because you've got numbers continuously coming through. Raymond Realty came out with numbers as well, surging after strong business update. Pre-sales jumped 128% YOY with premium residential demand aiding their growth. Ravinder here with all of the details.
Well, as Raymond Realty is in focus, and stock is up 10% on an intraday basis after reporting very good set of business update for Q1 of FY27. And company reported pre-sales at rupees 700 crore, which was up by 129% on a yearly basis from 306 crore in Q1 of FY26. And collection has also rise to from 550 crore for 47%. And what makes this performance even more impressive is that company did not launch any new residential project during the quarter, and management attributed the strong growth to healthy demand from premium housing, strong sales momentum across the MMR region, better price realization, and continued traction in the address by GS portfolio. And looking ahead, the company remained confident of achieving FY27 pre-sales guidance of rupees 3,930 crore, with 700 crore already achieved in the first Q1 of FY27, and it needs to deliver around 3,230 crore over the remaining 9 months of financial year. And management is also guided. Management has guided a 30% pre-sale guidance for the FY27, and the company expect to generate 7,000 to 7,500 crore GDP from the 4 project launches during the FY27, while EBITDA margin are expected to improve from to 17 to 19% as compared to 15% in FY26. And company continue to maintain 270 crore in liquidity, resulting into net debt of 827 crore. And over the long term, company maintains to generate 50% of its annual pre-sales from the JDA project by FY28, highlighting its focus on the asset-light growth strategy. So back of this strong business update for the Q1 of FY27, stock is up 10% on an intraday basis.
Right, okay, that's that on Raymond Realty. Although today, the big buzzer from the entire Realty pack is Lodha. That stock is almost notching a good 5% of a gain. Sunny, what are you reading on the charts? Any Realty players that you like in particular for a trade? And what about Lodha?
Yeah, I think a very strong set of update from Raymond Realty, and similarly, the kind of registration data which we are witnessing, Mumbai continue to surprise positively. So again, Lodha being a predominantly Mumbai-based real estate player, seems that 1Q should be a better in terms of pre-sales number as well as in terms of cash collection number. So among the stock which we like in the real estate pack is obviously Lodha is the first choice. And another play from an Aditya Birla Group, Aditya Birla Real Estate, where we feel because of diversification into the new territory, that the sales momentum should continue over there. So Aditya Birla Real Estate. And if somebody want to play on a commercial portfolio side, then Phoenix Mill is the stock where we feel over the period of next 1 or 2 years, 20 to 30% portfolio will come up for renegotiation, and the rent escalation clause which we have witnessed recently is closer to 15%. So that should again further aid earning growth for Phoenix Mill. So Phoenix Mill is another pack from a commercial real estate.
Right, good to get in that fundamental analysis on take on fundamentals of the company. But Kunal, on the chart specifically, a Lodha with the spot today?
Yeah, I think it's a very good move for the stock, and add to the fact that Lodha, I think over the last 1 month or so has gained more than 10 to 12% from its recent close. The stock was almost at 900, 950 mark, sub the long-term averages, and this move which has happened for Lodha, I think, is come back into a very trending up move. Real estate stocks are supposed to be considered to be a very high beta stocks, and we generally see a high-paced move for these names on a very short-term time frame. But you've seen that there's been a different change altogether for many of the real estate stocks. It's been more prolonged and it's been more consistent and gradual for these stocks to move up higher. The fact that in the process of doing this, many of these stocks have confirmed big breakouts for themselves. Oberoi Realty has confirmed a breakout above long-term averages. DLF is on the verge of doing that, I think at 680, 690 levels where it's trading right now. So chart-wise, I think the entire sector looks to be onto a very strong footing.
Okay. All right. So really looking good. Kunal, metals, would that at all stand out for you? A Tata Steel, a Hindalco, a Nalco?
See, the only trade in which metals should be considered now is if someone's bearish on dollar index, because over the last 3-4 days or this week so far, you've seen dollar index taking a bit of a backseat from 101 plus levels to sub 101 mark. So there's been a 1% odd drop for the dollar index, and that's aided the the move on the upside for many of the metal stocks, or at least arrested the fall for many of these metal names. Price-wise, these stocks are at a very lucrative point. For example, if you look at the charts for Vedanta, Hindalco, etc., many of these stocks, which are the performer stocks in the metal pack, they have come back to their long-term moving average, 200 DMA. So price-wise, that retracement has happened for these stocks. It's just that I think if dollar index starts to go into a much more sharper correction, then the pace of recovery for these metal stocks could be significantly high. So I still believe that maybe I think we could be in for some bit of a moderation on the dollar index. That's why I would not go for a big reversal, expectations on the middle pack in the immediate term. But maybe over the next week or so, there could be better price points which could emerge from many of these metal counters.
Okay. And Kunal, what about some of the power related names? Hitachi, Siemens. They've been under a bit of pressure today. Even CG Power for that matter. Should you go out and buy any of these names at this point?
Yeah, in fact, one of the stocks in the same space is GE Vernova. Yes. That's a stock which I think has corrected quite sharply. I was just looking at the charts from 5,600 levels to 4,300 levels thereabout is where the stock has corrected in just the last 6-7 days. And apparently what's happened is that many of the indicators are coming back into an oversold territory. So there could be a two-pronged move into these names. One is you might probably expect that first half of the next week, these stocks may go into a couple of days of a short covering bounce where, say, potentially over the next few days, you might expect a 3% to 4% up move into these names. But the real test could happen once these stocks come back and challenge their respective 20-day moving averages. And if they are able to, or rather unable to surpass those breakout points, then I think the second round of correction could be a little bit more severe and intense. So I would probably look at this as a very, very short-term trading play for the next 2 or 3 days only for these stocks. Wait for the bounce, play the bounce for the next 3, 4, 5%, and then keep the stocks back in the radar, because if they are unable to surpass their respective 20-day moving averages, there could be a retest of the previous lows which these stocks have hit.
Okay, Kunal, Sunny, both of you, we'll let you go on that note. Thanks as always for taking the time out and joining in. Let's begin winding up for the day and the week. And just want to bring in what the over the week picture has been for the Nifty, because we've definitely not done bad. While today we're a little bit off from the top of the day and we're closing in with a 90 odd point gain. For the week, we've done okay, a 1% of an uptick. More importantly, we did manage to recover ground at that 24,000 mark. And for the week, we are actually closing in at the 24,350 thereabouts print for the Nifty futures. So not looking bad at all. The week, of course, was dominated by a lot of news flow around banks and around IT as well. Casualties like KPIT yesterday and today, HCL Technologies with that one big acquisition finally manages to resurrect sentiment. The Nifty Bank, though, for the day is closing in a little bit soft, and IT as a pack has definitely managed to hold out. Some of the pharma pack names and healthcare names as well managed to come back to the fore. So Max Healthcare, Apollo Hospitals, etc. were looking quite okay. Metals, of course, has been a big theme all through yesterday and today. So you've got a Nalco, Hindalco, Tata Steel. All of these names have managed to hold out quite well. And then, of course, on the flip side, today banks have taken a bit of a breather. So Axis, SBI, Kotak, these have all slackened. L&T as well was a pressure point today, and M&M as well after an excellent reaction post its monthly sales data. It quietened down a little bit, along with CG Power, Union Bank, Policy Bazaar, Power India, and GVTNT.
Yeah.